Welcome back, everyone. First, I want to apologize for the delay. Thank you for your patience. Now that we're all here, we'll dive right back into the lesson. A quick reminder, make sure you have your notebooks ready to take notes because not everything will be on the slides. Writing down key points and examples will really help you understand the concepts better. Let's make sure your study journey stays smooth and easy, just as we promised from the start. A business transaction is when something of value, like money, goods, or services, is exchanged between two parties. Simply put, whenever property, like products or money, changes hands in a business, it's a business transaction. For example, in a clothing store, when a customer buys a shirt for $20, the store gives the shirt to the customer, and the customer gives $20 to the store. Here, property, the shirt and money, is changing hands, so it's a business transaction. This happens every time the store sells an item, pays for stock, or even when it pays rent for the store space. Property, money or goods, is exchanged. According to BPP, the main types of transactions are cash transactions and credit transactions. These two categories cover how money flows in and out of a business. Cash transactions involve immediate payment, while credit transactions involve a delay or a gap in time between the transaction and the payment. Now let's explore these types in more detail and see how they apply to sales, purchases, and other important business transactions. Main types of transactions: sales and purchases. In business, the core transactions are related to selling, sales, and buying, purchases. Both of these transactions can either be cash, immediate payment, or credit, payment after a period of time. 1. Sales transactions. A sales transaction is when a business sells goods or services to a customer. The payment for this sale can either be received immediately, cash sales, or later, credit sales. Cash sales. A cash sale happens when the customer pays for goods or services immediately at the time of the transaction. The payment can be in cash, by card, or via bank transfer. Example: imagine you own a clothing store. A customer buys a shirt for $20 and pays with their debit card at the counter. This is a cash sale because the payment is received right away. A credit sales. A credit sale happens when a business allows the customer to take the goods or services now, but the payment will be made later. There is a gap in time between when the sale happens and when the business receives the money. Example: suppose you own a furniture store and a customer buys a sofa for $1,000 on credit. The customer takes the sofa today but agrees to pay you within 30 days. This is a credit sale because you are waiting for the cash to arrive after a 30-day gap. 2. Purchase transactions. A purchase transaction happens when a business buys goods or services. The payment can be made immediately, cash purchases, or later, credit purchases. A cash purchase occurs when a business pays for goods or services immediately at the time of the transaction. Example: you own a cafe and you buy coffee beans for $100, paying for them in cash on the spot. This is a cash purchase because the payment is made right away. Credit purchases. A credit purchase happens when a business receives goods or services now and agrees to pay the supplier later. This creates a gap in time between when the goods are received and when the payment is made. Example: imagine your cafe buys coffee beans worth $500 from a supplier, and they allow you to pay in 60 days. You receive the beans today, but will pay after the 60-day gap. This is a credit purchase. Other types of transactions. 1. Payroll transactions. Definition: payroll transactions involve paying employees for their work. This includes wages, overtime, bonuses, and any deductions for taxes or benefits. Example: if you have 3 employees at your cafe and you pay each of them $800 at the end of the month, that's a payroll transaction. These payments include tax deductions such as income tax and Social Security contributions. 2. Depreciation transactions. Definition: depreciation transactions account for the loss in value of a long-term asset over time. It's an expense recorded in the books, but it doesn't involve immediate cash. Example: suppose you bought a delivery van for your cafe for $20,000. Every year, the van loses some value due to aging and usage. You record $2,000 in depreciation annually. This is a depreciation transaction. No cash is spent, but the van's value is decreasing. 3. Loan transactions. Definition. Loan transactions occur when a business borrows money from a bank or financial institution and agrees to repay it with interest over time. Example, let's say you borrow $10,000 from the bank to expand your cafe. You repay this loan in monthly installments over 3 years. These repayments are loan transactions because the business is gradually repaying the loan amount and interest. 4. Expense transactions, including taxes. Definition. Expense transactions cover the costs of operating a business, such as rent, utilities, office supplies, and taxes. Example, every month, your cafe pays $1,500 for rent, $200 for utilities, and $300 in taxes. These are expense transactions because they are regular payments made to keep the business running, including tax payments. 5. Dividend transactions. Definition. Dividend transactions occur when a business distributes a portion of its profits to its shareholders. Example, if your cafe made a profit of $50,000 and you decide to distribute $10,000 to your investors, this is a dividend transaction because it involves sharing the business profits with shareholders. Recap for starters. Cash transactions are when money is exchanged immediately at the time of the transaction. Credit transactions involve a gap in time between when the transaction happens and when the payment is actually received or made. Every type of transaction impacts the financial health of a business, and it's crucial to keep track of them to manage cash flow and financial reporting. Understanding these transactions will help you make sense of the different financial activities in a business and how they are recorded.